Hey, everybody. Thanks for attending. We appreciate you being here. This is Glenn Setchfield, VP of Marketing for DMI. Actually, in case you don't know who DMI is, we're an IDC or an IMO, wholesaling annuity and life insurance out of Boston, Massachusetts. We've been in business for 35 years, and we like to put webinars on like this to help your business. So today's webinar is going to be especially interesting because we have not one, but two VPs of our very own from DMI on board. We have Joshua Rhem, who is our life VP. He's down in the bottom left Hollywood Square there. We have Tyrell Jensen, our VP of Annuity Sales, in the bottom right Hollywood Square there. And they have practiced many times multiple life and annuity sales combo ideas. So today we want to talk about a few of those. They can create incredible outcomes for clients. And I'm really not going to say much about the topic today because I'm eager to just get into this with Josh and Tyrell. Honestly, I haven't even seen the presentation, so I'm really excited to see it. Maureen, I know you've seen it, so I think everybody's in for a treat today. I might let Josh take a moment to talk about the agenda some more. But first, I just let everybody know that please the Q&A function here. We have it there for a reason because we really do want to get to all your questions with helpful answers. And with that being said, also the survey questions that we have are a great way to interact with us as well. So we really appreciate all your engagement, and those funny looking QR codes there. Those are easy ways to contact Josh or Tyrell if you want to ask them questions after the webinar, or maybe even during the webinar if you're like really eager to call them. I don't know how they would do both at the same time, but that would be interesting. So with all that being said, Josh, what do you have to say about the agenda, good sir?
Well, thanks, Glenn. And we hope that you, Glenn, and everybody else enjoys seeing it for the first time today. Thank you for coming today. We know you guys are busy. Your time's valuable. Thank you for carving out 20 minutes to half hour. So we won't keep you long today. We want to get you back to doing what you do best. But we'll talk about the opportunity. There's tremendous opportunity to both help your clients in a meaningful way and grow your business. So we'll talk about solutions to do that while employing two solutions that involve two products that involve two sales. So again, a great opportunity to bring income into your business while offering a meaningful solution to your client. The old way versus the new way. What we're telling you today is nothing new. We'll tell you how we're using these strategies with current ideas and tools. We'll talk about two case studies now, both of them involving utilizing qualified IRA funds, because oftentimes the bulk of our clients' assets are in IRAs. So we think that's a very relevant area to touch on. We'll talk about conversation starters because we want you to take this and be able to actually utilize it in your practice. And that's the best way to make up for your time today is if we can actually put it into practice, utilize it, make some money from it, help more clients, and it'll be a valuable use of everybody's time. And then, of course, the conclusion, we look forward to summing it all up and addressing any questions you might have. So next slide, Glenn. All right. So again, the old way of doing things would suggest, again, that this concept of using an annuity and life insurance combo, it's not new. If you've been in the business for a while, you might have done this before or at some point in your career. But, just like our cell phones, the innovation and the products that we use and the way we use them, they change over time. And that's no different than with our financial strategies and the financial tools that we use. So we're going to talk about doing things the new way. And when it comes to IRAs, obviously we're talking about taxes. Now it's interesting, even though for the majority of our clients, the majority of Americans, the estate tax probably won't apply to them. Even as that rule sunsets and the threshold for the estate tax applying to someone decreases, even at that point, most of our clients might not fall under that category. But that doesn't mean that your assets won't be taxed at death because, again, most of our clients' assets are in IRAs. And that's where it gets taxed when it gets passed on to the next beneficiaries. So what are we solving for today? We're solving for just that, passing money to beneficiaries, and also the ever important need to plan for long-term care. So the old way, when it came to passing on money to beneficiaries, when it came to it coming from an IRA, is you would just let the children inherit it at some point. They used to be able to at least stretch it throughout the course of their lifetime. They can't do that anymore. They at least have to liquidate that benefit over 10 years, which means they're going to get more money at a higher tax rate. That's one reason why it's an old way of doing things. And also, if you've used a strategy before, you might have used a SPIA, a single premium immediate annuity, to fund the life insurance portion of the strategy. But while there's nothing wrong with that, you still may do that. One thing we lose when we use a SPIA, of course, is control. And even though a client may say, I don't need the money, just from a psychological standpoint, if you can address the need and still give them control of the asset, still give them some liquidity, it's just all the better, and you're more likely to close that business. So we have products that we can create some income to fund life insurance while giving them control of the asset still. So in the examples on the next page, we're going to see how we can carve out a portion of the IRAs to maximize death benefit and to provide some important living benefits. So let's jump right into the first case study. We have John and Mary. They've done pretty well for themselves. They're both in good health. But although I'll speak to, real world scenarios to where if there are some health concerns, how would that affect the life insurance portion of it? But they're both in good health. They have 2 grown children, have some grandkids. They've done pretty well for themselves in terms of having some guaranteed income in the form of Social Security income, pension income that has survivor benefits. They also have some rental income. So you see their monthly need is $7,500, and they've got $9,000 of that addressed, so above and beyond their need, and much of that isn't even coming from portfolio assets. So just in a great place when it comes to income. And then you can see their assets, over $1 million. Inheritance is important to them. They've received an inheritance. They want to do the same for their children. And the bottom line is they don't need all of their qualified assets. They want to leave it to the next generation. So what are we solving for? That's important. We're solving for the death benefit. We're solving for the legacy. Whether or not something is a good strategy is dependent on what they need the money to do for them. So they need the money to grow as much as possible for a death benefit. So that starts with the annuity portion of it. So Tyrell, where do we start?
Yeah, thanks, Josh. So a couple things I want to kind of point out here. One, the client could take money from other sources to start funding this life insurance. The reason we're going after the IRA is that the client says, I've got other income. I don't need the IRA. It's taxable, so I probably won't want to take money from it. And oftentimes, I've even found with my own clients, oftentimes they earmark and say, that qualified fund, I'm just going to pass that on my IRA. I'm going to pass it on to my kids. Well, obviously, the problem with that is if they wanted to liquidate that immediately as a lump sum, there's going to be a large tax consequence. So what I often do when I'm structuring this type of a scenario where I say I'm going to take a qualified fund that's fully taxable and pass it on to the kids, I like to do a couple of things. One, I always say, I tell my clients, let's let the IRA pay its own taxes. So we're not going to have you pay the taxes. The tax consequence is going to come out of the income that we receive from that IRA. And then we're going to take what's left over and we're going to pay that into a life insurance policy. So in this scenario, we're going to take $250,000 of an IRA. We're going to put it into the Athene Ascent Pro 10. Now we're using this product. I'll tell you, this product it works with other index annuities. This is just an example of one. Happened to be at the time the highest payout. And so we'll always look at and find the best product. But in this scenario, we're going to use this Ascent Pro, and we're going to stick in $250,000. Of that $250,000, it's going to spit out day one immediate income of $17,063. In this scenario, as we looked at the client's income, they're going to be in a tax bracket of 12%. And so we're going to take off the top of that income from that IRA, 12% off of that, leaving annually $15,015 left over that we'll be able to fund into the life insurance policy. So Glenn, we can go to the next slide, and we'll kick it back to Josh to talk a little bit about what that premium payment will buy.
There we go. Okay, good. So yeah, so we started with the annuity. We've created an income stream in the form of $15,000 and $15,015. So first of all, we'll be taking that asset that's earmarked for death benefit, and then we're putting it into another asset, another contract, life insurance contract, also earmarked for death benefit. So when we're moving it from one pocket to another, we're really just repositioning the asset, but we're doing so in a way that's going to leverage that asset much greater than where it was. So in this case, we're going to take that $15,000 or so and put it in an annualized premium into a universal life insurance policy, and that's going to be paid each and every year. But again, it's being moved. We're leveraging that still for death benefit. So when we do that, we're going to put it into a survivorship universal life benefit, which means that it will pay out when the second insured dies. And that type of policy just leverages the premium even more into a greater death benefit. And that death benefit is $723,492 tax-free. A universal life policy that's second to die. Something like this, you can expect it to be fully underwritten at these levels. This also is guaranteed to age 100. Now, there's some design aspects you can use when you're dealing with universal life insurance. For instance, you might try to leverage an even greater death benefit by guaranteeing it to a lesser age. But for this, we want to give them the peace of mind that it's always going to be there, at least until age 100. And this is standard non-tobacco. So as I mentioned earlier, real world situation. What if the wife, Mary, had some health issues and she was a table 3? In that situation, you would still get a $552,000 death benefit. What if both had some health issues and they were both a table 3? Then that would still leverage about a $441,000 death benefit. So again, to be able to leverage that death benefit gives us some wiggle room. Standard non-tobacco would be ideal. Actually, preferred would be even better. But if we run into some health issues, it's still worth giving us a call and seeing the type of death benefit we can achieve. So if you go to the next slide, I'm sorry. So go to the one before that too. Sorry about that, Glenn. So again, you have the death benefit. There is some cash value. It's not an objective. It's there, but we won't worry about that. But this also does give you a chronic illness benefit to where you can access a portion of that death benefit. Now that too speaks to preserving the death benefit, because if there's a long-term care need, we won't have to dip into other assets to address that. So that is a secondary benefit that's inherent to this particular product. Now you can go to the next slide. All right, cool. So again, if we go back to what are we trying to solve for, and we're trying to solve for a death benefit, then we can more objectively and honestly assess the performance and the value of a life insurance policy. And it's just tough to beat a life insurance policy if you're in good health and your objective is to pass on the asset to a beneficiary. So for one thing, we know that in a life insurance policy, there's no waiting for that asset to grow like you would if you were trying to invest these assets in another type of account and grow them for the future. The day one benefit is at $723,000. So God forbid they die together in the first year, which would be terrible, but that does happen. Well, that would be an astronomical rate of return on that $15,000 premium to get the $723,000, somewhere upwards of $4,000% in terms of a rate of return. But then let's look at some more longevity. If they make it to 88, that's a 7% rate of return on the premium. If they make it to 93, that's still a 4.73% rate of return. If they make it to 100, God bless them, 2.37% rate of return as is. But remember, this is tax-free. So in order to achieve these type of returns for the sake of a death benefit and another type of investment account, you would have to get 9.373% year after year in that investment in order to have a tax equivalent yield on the life insurance policy to achieve that same death benefit. Not a lot of accounts can do that year after year, certainly not without risk. So again, here we see the value of the life insurance policy being used for death benefit as the main objective. So great leveraging, great benefit that they'll receive at death. But what's interesting is, if I'm not mistaken, Tyrell, as we're making these premium payments and as we have this death benefit, there's still something potentially going on in the annuity account still, correct?
There is. I want to ask you a quick question first, Josh. I was thinking, What happens, let's say that we're 10 years into this policy and the clients say, my objective has changed. I no longer want to pass all this money on, or you know what, life didn't plan out as we needed or wanted or expected, and now we actually can't afford or don't want to put the money into this life insurance policy. We need to use that income for something else. Is there an option to undo this or to reduce this or get rid of the cost?
Yeah, so there's flexibilities that's inherent with policies like these UL policies. So there's cash value buildup to where we could say if you stop paying today, you could get a reduced paid up, or we could tell you how long this would last. So there's definitely flexibility to this. Now, of course, if we're doing our planning right, again, we only allocate a portion of it. So there's going to be like liquidity outside of this to turn to if there's an unexpected event. But if the worst case scenario happens, they've blown through all their other assets, just something terrible happens, there is flexibility to stop paying, to benefit from the cash value, to get some type of reduced paid up benefit.
I like that. That's one of the things for me. I always like to put in plans in place that don't completely handcuff a client into the plan. So if something does change, or financially, or if their objectives change and they say, I no longer want to do this, then how do I undo it? So I like that. I appreciate that there is that flexibility. As Josh was starting to allude to, yes, the annuity, there's still additional benefits. Glenn, if you want to go to the next screen, I'll kind of walk through some of those additional benefits in the annuity. So as I mentioned, we put the $250,000 into this Athene Ascent Pro 10 bonus indexed annuity. And the whole point of that was to get this $17,000 a year income that we would then pay taxes on, and then with the leftover be able to put into that IUL and life insurance policy to be able to leverage a death benefit. But let's say that something did happen, like Josh mentioned, heaven forbid that they both passed away in the first year, there would be that death benefit of $723,000. But in that, with that, there's also still the leftover cash value, the accumulated value in this policy. So if we look at the very first line and we go over to the accumulated value column, that shows in that very first year, there's still going to be $278,000 left over in that. That is assuming we're looking at the last 10 years return on the index and applying it to this scenario. So there would still be some cash value left over, quite a bit, left over if they were to pass away in that first year. Now, even if it happens later on down the road, we can look at if they live all the way up to age 85. One of them could have passed away prior to. This income is on a joint basis. So as long as one of the insureds is alive, and one of the, Mary or John, only one of them has to be alive for this income to continue. And that life insurance policy, as Josh was describing, is also a second to die. So only, both insureds have to pass away before that policy pays out and the premium is no longer needed. So in this scenario, if, let's say the husband passed away earlier on, and let's say Mary lives until age 85. At that point, there would still be a remaining death benefit in the IRA. And again, this is assumed based off of the last 10-year returns of the index. There would be still $325,000 left in that IRA. Now, that might not be exactly how it plays out. The 10-year performance of the FIAs over the last 10 years, it might not work out going forward in that way, but there is still a possibility to have cash value left over to pay out. And we can even see down all the way to at age 90, there's still over $300,000 left in that policy. So Glenn, if you'll kick over to the next slide for me. So wanted this kind of just review what this has actually done, this indexed annuity, how the past performance has worked in other scenarios. So this first dark blue box shows the last 10-year, the most recent 10-year performance of these indexes that we're using. And we'll notice that down below that dark blue box, the first one on the left-hand side, it has a rate of return after charges of 6.84%. You'll notice on the far right, that lighter blue box that says the lowest index scenario, that one's the lowest 10-year time period out of the last 20 years. And its annual average rate of return in this index is 5.32 net of charges on this. So this, indexed annuity has had some very strong performances, and we're using a variety of different indexes that are all non-correlated indexes. So it's spread among, 5 different indexes. So there's a good opportunity for growth, which isn't what we're trying to accomplish. It's just an added benefit. So on top of really the biggest, benefit and the biggest thing we're trying to solve here for these clients is that tax-free death benefit for inheritance, but we're still able to take and use this indexed annuity and have growth on it over their lifetime and still be able to potentially provide additional benefits. Again, going back to that new versus old way of doing it, if we were to use a SPIA and do just a life-only payout, today these indexed annuity rates on the FIAs, the income riders produce as much or more than what SPIAs are producing. So we wouldn't really be able to get any more by using a SPIA. But if they were to pass away prematurely before all the funds were used up, there would be nothing left over in a SPIA to pass on. Where in this indexed annuity, they would be able to pass that on. So Glenn, next slide. I'll kick it back over to Josh to to walk through on this one?
Oh, yes. This is, where they were before and what we accomplished for them after. So all in all, we wanted to solve for the death benefit. So we've taken that $250,000 unused, unneeded IRA. They're still in a great place in terms of their income. We just needed to solve for their legacy objective. So we created a tax efficient and in fact tax-free death benefit while utilizing that and utilizing the annuity, as Tyrell said. We go based off of guaranteed assumptions. But if any of what Tyrell plays out, and there's a high of that based on how well these indices are built, and then you're looking at close to $1 million death benefit between the two. Yes, his portion will be taxed, but I'll take $1 million any day with a small portion of that being taxed. So we've put them in a great situation according to what they were trying to solve for. All right, any questions on that? Please feel free to ask them towards the end. Let's quickly go through this next case study. Yep, go ahead to Roger. All right, Roger, thank you. So Roger, really quick, he's a 65-year-old widower, one-girl child. Already from those 2 points is the profile of somebody who should be thinking about long-term care. Again, similar scenario where he has good assets, good income, doesn't need all of his qualified assets for retirement income. So let's carve out a portion of that to address the solution. What are we solving for here? We're primarily solving for long-term care. But again, where it starts will be with the annuity. So let's quickly kick it back to Tyrell again to see where it's going to start.
All right, appreciate it. Then can we go to the next slide? So in this scenario, again, we want to utilize an indexed annuity to be able to provide some withdrawals from this $250,000 that we're wanting to put into a policy for long-term care. Because of that tax consequence, again, we don't want to just liquidate it all up front. We want to do this, with the taxes in mind. So we start off and put $250,000 into the Athene Agility product. And now this one doesn't have any fees for this product. And it actually includes a fee-free income rider, which again, we'll talk about in a little bit as just an added benefit to this product. But it's not really what we're using this for. For this one, we want to just take free withdrawals. Now, most indexed annuities, and part of why we use this particular product, and we have a couple of different products that allow for this, but this is somewhat unique in the industry. This product allows for 10% free withdrawals of the original premium amount or the account value, whichever is higher. So what that means is that if we stick in $250,000, we are guaranteed to be able to take a free withdrawal of $25,000 every year, even if that $25,000 is more than 10% of the accumulated value. So I know in 10 years, I can fully liquidate this $250,000 without any surrender penalties for pulling that money out. So we're in this situation, we're going to put in $250,000. Over the next 10 years, we're going to take a $25,000 distribution. Now, out of that $25,000 in this client scenario, he's going to be in a 22% tax bracket. So we take off the 22% off of that for taxes, which leaves us $19,500, which will be able to go and fund a long-term care policy over 10 years. So Josh, do you want to take over and show them that long-term care policy?
Yeah, perfect. So Nationwide Care Matters is one of what we call an asset-based long-term care product. So when somebody leads with, hey, I want to address my long-term care need, not, hey, I want life insurance, but long-term care would be nice. When long-term care is the primary objective, we want to look at something like this because it's going to maximize long-term care benefits. So without getting too deep into the mechanics, how it will simply work is we'll take those premiums that Tyrell will create, and it'll amount to $195,000. That goes into the policy, and much like any other life insurance policy, we can accelerate those benefits. On top of that, we add an extension of benefits for 4 years, and between those two buckets, it creates an initial benefit of about $487,000 before inflation. Now, there's also a compounding inflation rider on this. So between those two mechanisms, what it will create is by age 80 is a $6,765 monthly benefit, that's day one, and by age 80 at $10,000, so monthly benefit. That's the basic mechanics, but the focus is these products focus on maximizing long-term care benefits. So if you go to the next slide, now the old way long-term care, traditional policies, it's use it or lose it. Not in this case. Day one, if the long-term care benefit is never used, there is death benefit there. If the long-term care benefit is never used, it's $162,000 day one. By age 80, you get a full return of premium in the form of the death benefit. There's also some surrender value there, so you maintain some liquidity. By age 80, you would get $119,000 back if for whatever reason you said you no longer wanted the care. Now, with this too, there's different policies and ways to design this to where if you said cash value, some liquidity is a little bit more important to me than just getting some of it back, we can dial it up or down to where we reduce the long-term care benefit, increase the cash value, and so on and so forth. So there's flexibility. In this case, we wanted to maximize the long-term care benefit because he's so well positioned in other areas. All right, so if you want to go to the next slide. Okay, so here again too, here's the benefits, and this ledger almost speaks for itself because again, what are we solving for? So from day one, these premiums are going to purchase us $6,765 for 6 years of benefit, but that's going to inflate throughout the years to where by age 80, $10,000 a month for 6 years, that amounts to about $818,000 benefit. So what are we saying here? We're saying outside of this, as you see the farthest right-hand column, you would have to return 10.93% every single year to use these assets in some other form of investment. And when you do that, some people refer to that as self-insuring. I have the assets, I don't need the insurance, so I'm going to self-insure. But if you go to the next page, so self-insuring really is a misnomer because self-insuring doesn't leverage the asset. That's what insurance does. If you're quote unquote self-insuring, you're going to take that $195,000. $1 is going to pay for $1 of care. With the cost of long-term care, you're going to blow through that in probably less than 2 years. And once you've gone through that, then what do? Well, you got to turn to your other portfolio assets, your other sources of income. Self-insuring will deplete your portfolio assets far faster than any of your returns could possibly replenish it. So that's truly not self-insuring. You're just using your own money and depleting your own money. So instead, if long-term care is the objective, we need to self-assure, use the asset, leverage it to where your $195,000 will ultimately pay for $10,000 a month, which we just saw from the last screen. It amounts to about an $818,000 benefit. We hope you use it. That's what it's there for. And on top of that, kind of like icing on the cake, even if you go through all your benefits, there's almost like a final expense policy built in. So you've put in $195,000. You've used $818,000 for your long-term care. Your heirs would still get a $32,000 death benefit after all is said and done. I don't know of a policy that could accomplish that when your objective is for long-term care. So that's the solution when we're solving for just that. A couple more interesting items on this if you go to the next slide. All right, so for this, when you have long-term care conversations with your clients, and this is a good takeaway, long-term care needs analysis is different than life insurance needs analysis, in that I would suggest you get your clients to think about where they want to receive the care, what type of care they envision themselves receiving, and who do they want to give it to them. Is it the type of care that needs to be done in a nursing home, or could they stay in their own house? Do you want your spouse or your son to provide the care, or could we pay somebody to come to our house and do it? Or if it is a loved one, can we pay them to do that for us? So all that is to say, we like to focus on cash indemnity plans, which once you qualify for the care, we just give you the check and you can use it for whatever you need, wherever you see fit. And oftentimes for our clients, that means they focus on the quality of life, not focusing on paying for a nursing home. There's a lot of things you can do with this money to make sure you can maintain the quality of life that you envision should you need this care. The last thing about it is with this particular product, we know that long-term care policies typically have a 90-day elimination period, but this will pay your 90-day elimination period retroactively. So it'll pay those 3 months and the 4th month altogether. So if your benefit is $10,000, you go through your first 3 months and then your 4th month, you now qualify for the payments to start. Your first benefit payment is $40,000. That's pretty incredible. And it just shows the value of this type of plan and this type of policy when your objective is to pay for long-term care needs. What's our next slide?
Yes, I'll hop in.
Yeah, so I'm sorry. In this case too, even having done all that, I think there's also another story to tell about what's going on in the background in the annuity still.
Yeah. So with this one, similar to the other example that we used for the IRA going to a life insurance policy, just like that one had other additional benefits, so does this one. So the very first slide that I showed with this Athene Agility, that one was assuming zero returns in the indexes for the entire 10-year time. Now, that's not likely to happen. There's not been a period of time when we had the markets down for 10 consecutive years. So we are going to have returns that take place on this indexed annuity. And so those returns are going to be additional benefit or value to the client. So if we look here at the end of the 10-year period where we've pulled funds out, that $25,000 a year, and then we've used up the client's $250,000 original premium that we put in, there's still leftover money. So at the end of 10 years, that client could take that leftover amount. And at the end of 10 years, this is based off of, again, the last 10-year performance of the indexes. There would be over $200,000 in accumulated value at that point that the client could, surrender the policy and transfer that out. The client could leave it in there. This has that free income rider that I had mentioned earlier. At that point, if they wanted to turn that income rider on, they could, and that would result in a starting income of over $12,000 a year. This does have an increasing income. So every year, the income could increase based off of the index returns of the policy. So it would start at over $12,000 a year at that point. But really, the policy is very flexible at this point. We've used it for the primary purpose of buying that long-term care policy. And now we have a potential bucket of money left over. And again, that could vary depending upon the returns, but there's a bucket of money there that the client has options. So Glenn, if we want to switch to the next screen, I'll show what the bucket might look like based off of another rate of return. So the previous one we were looking at showed the rate of return based off of the last 10-year performance of the indexes. This one, I'm just saying, what happens if we don't perform quite as well as what the last 10 years look like, but what if we just have a 5% annual return on this? At that point, at the end of the 10 years, we'd still have $77,000 of leftover money that the client could again access or transfer out, or they could start an income stream. In this case, that income would start off at $6,800, but again, that's an annual increasing income. So depending on the performance of the indexes, that income could go up as well from there. And yeah, go ahead and hop over to the next screen, Glenn. And then, so this just shows what the Agility has returned over the last different 10-year time periods. So the most recent 10-year time period, that one averaged 8.41%. The highest it's ever done was 9.29% for a 10-year time period over the last 20 years. And the reason I used that a 5% rate of return in the last example and said, let's just look at it 5% is because when we look at the lowest 10-year time period over the last 20 years, the lowest annual average rate of return is 6.96%. So we're assuming that it doesn't perform, as well as what the lowest it's performed in the last 20 years. So again, the likelihood of having a bucket of money left over from that $250,000 after we've already purchased that long-term care policy is pretty likely to have some money there. Now, how much, that's unknown until we get to the end of the 10 years and see how the indexes perform. But potentially it could have a pretty large bucket of money. So to kind of review and sum up this case study, we had Roger, his biggest desire was long-term care. He's a widower. He's really concerned about who's going to take care of him if something happens and how to pay for that. He doesn't want to burden his children. And he had no long-term care plan in place. So we were able to take, some of his money from his IRA, $250,000, and put that into that Athene Agility product. Now, assuming that there was nothing left at the end of 10 years, he would have still $200,000 in his IRA left over, but he'd have that Care Matters policy that would be able to provide him day one $6,750 for a monthly benefit. And of course, as Josh showed us, that benefit will just continue to increase over time. So now he's able to have a plan in place and, really take care of that concern, that need, and no longer has to worry about who's going to take care of him. How is he going to make sure that it's provided for and he doesn't spend through all of his assets and has to, turn to his child to help take care of him. So if we want to move on to the next slide.
Well, if you go back there, I think it's a good slide because if you look at what changed, we've changed very little. but it's made a huge impact. And that's important too, because we're not asking you to go to your client's portfolio and just pillage all of their liquid and investable assets. It's what's the solution. And if there's a portion of that that's unneeded towards your income goals or other goals, let's carve that little bit out and leverage that to address a very important need. So I think it's a great slide to show it's a simple solution, one that will be palatable to most clients because you're not just taking away the control of their assets, and we're addressing a huge need. So that's all I had to say about that. And we can conclude on the next slide. I think it's the last slide. Yeah. So again, who does this work for? So I'd be willing to bet that everybody on this webinar has clients with qualified assets. So it's a matter of going back to them and determining if they need all of those qualified assets, and is there another goal that they want to accomplish? And if there is, just come to us and say, hey, here's my client. What do you suggest? They have this legacy goal. They have this long-term care goal. And those are the two primary goals you're going to run into that would make these combo sales ideas useful. So if you see that in your book of business, if somebody in your book of business comes to mind right now, even just give us a call, and it just starts with a discussion. It's not going to work with everybody, but we'll miss 100% of the shots we don't take. The clients need this. And if we don't talk to them about it, somebody else down the street is going to identify it for us. And we don't want that. So go back to your clients, try to identify this opportunity. Call to action for me on my end is I have a great long-term care conversation kit that can help guide these conversations and can also help quantify the need. It's the better way to do a long-term care needs analysis. So please call me for that and any other questions, anything you want to add, Tyrell.
Yeah, just one other quick thing. I know these examples that we use specific product. Know that if you are a registered rep and maybe you said, well, that product doesn't work for me. I can't use that product. My broker dealer doesn't allow that, or I don't want to use this company. We have several different carriers that can fulfill these needs. And so really the examples that we used were just that, examples. Your clients don't have to look exactly like the examples that we gave, and we don't have to use the exact products that we demonstrated here. Those are just some good examples of what's available, but we'll definitely look case by case and even tweak. Sometimes, for example, the IRA to life scenario, you might look at it and say, well, we don't really want to have a lifetime income. Maybe we want to fund that over a shorter period of time. And we can look at those examples and even show times where we tweak the example that we used. The main idea is that they have IRA money that they don't want to use for income, and they want to use it for another purpose. And how do we minimize the tax consequence to the client and to the beneficiary if we're passing that on? And how do we maximize what they're trying to accomplish, whether that be a legacy or long-term care? So give us a call when you have a case, and we can walk through and really design specifically for the client what would work best.
Hey guys, I do have a question from the field. If I could just put this in.
Sorry.
It's in reference to the first case study, but could you implement the first case study strategy with a term policy with the ability to convert to a paid up permanent policy?
You could, and that's kind of you could start with term that would obviously give you a larger death benefit, probably, depending on the length of the term. Is it 10, 20 years? You could do that. It would result in a larger benefit. And then to convert to a permanent policy, I think that's what you mean, is to exercise a convertibility privilege. You could do that. Just keep in mind that it's going to be at a later age. There'd be no underwriting to convert that, but at that attained age, it might be expensive. So what I might consider, if you wanted a larger death benefit, is maybe turn to more of like an IUL product where it's not guaranteed to 100. Maybe it's guaranteed to 80 and 85. That will give you a larger death benefit. And maybe they're comfortable with the potential based on the cash value performance that it could still get you to 100. That might be a better way of accomplishing what you would try to accomplish using a term policy.
One other quick thing, Josh, I was just thinking about that question, and I'm wondering if they're asking if the client, let's say the client was younger, in their 40s, and so they weren't going to fund the life insurance with the qualified money today. Let's say they're in 40s or 50s, and they wanted to buy a term policy today, and then once they retire, and then they can move that IRA money without a pre-59.5 penalty, and then they could convert at that time and still convert and use the IRA money, and we could dial that in. So that could be an option as well if they did use a term policy to potentially solve that for a younger client, where you could say, we'll use the term, or if they're retired now and they might have an old term policy that could be converted that could also be a potential solution for it, though it'll be hard to dial in the premium amount from that. But if they're an unhealthy individual today and they have that term policy, we potentially could convert it and still use the IRA to fund it.
Yeah, that's a good. There's a number of different ways to design this. So if you see the opportunity, call us. We love doing that. Some people watch Netflix. We sit at home at night doing case design because it's fun. So just give us the scenario and we'll enjoy designing the best strategy for you.
He's not kidding either.
I'll watch Netflix and do case design at 10 o'clock at night.
Yeah. But so if you guys haven't caught it, you have an open invite to call Tyrell or Josh. And just to let you know, if you enjoyed today's webinar, we do have another one coming up on, I believe, March 6th, entitled Unlock the Power of Key Person Insurance. So we won't have Tyrell on that one, unfortunately, but we will have Mr. Joshua Rhem, along with from Nationwide, Allison Hoyt. So, I think that's like the secret sauce for successful businesses, providing a safety net that savvy financial professionals can leverage. So check that out. And, I think you'll enjoy it. Much more to come also around business owners this quarter. So look out for upcoming DMI-U webinars. And beyond that, I think that's it for now. Do we have any other questions at all, Maureen? Anything? We're good? All right, guys. Hey, Tyrell and Josh, thank you so much for being here. Really appreciate it. Great presentation. And thanks for the engagement from the audience. And that will conclude the webinar, guys. Thank you so much.
Thank you.
Happy Wednesday, everybody.
Thanks, guys.